All right, welcome back. I have added a new position to my dividend portfolio. For you all that are with me on this particular journey today, I want to spotlight this particular ETF, and that ETF is QQQI. Okay, it blends the large cap growth exposure with an income focused leading with tech. This particular fund aims not just to participate in the upside of the large cap tech growth stocks of the NASDAQ 100, but to also generate a respectable monthly income stream through an options-based income strategy. Okay, to bring the investor those sweet monthly dividends that every dividend investor absolutely loves. So if you love dividends, welcome to the channel. If this is your first time here, welcome. If it's not, welcome back. Okay, so this is a stock that in today's climate can actually be considered a two-pronged position that is aiming to hopefully bring the investor both the capital gains from the large cap tech focused stocks while also capturing the monthly payouts along the way. And in my experience with the stock market, this is a very rare kind of thing. You don't find this every day within the stock market. That is an ETF that can do both. Usually you have to sacrifice one for the other. So let's talk about what their fundamental basics are and their strategy is. Okay, QQQI is an actively managed ETF that was launched in January of 2024 by Neos Investments. So this is brand spanking new. Actively managed means that they have a team of analysts that watch every single company within this ETF to make sure that those companies that they have continue to meet the expectations of the fund. And typically, if and when a particular stock does not meet the company's requirements and expectations, it gets booted from the basket of stocks and replaced by another one that does. Okay? And that takes work. No one is doing that for free, which means that there is a team that has to actively manage these things. Okay, so when expense ratio comes into play, this is what it means. The term expense ratio simply means that there is a cost. Like with most ETFs, there is a cost that is going to be associated with overseeing the fund's progress. There's a team that's got to sit by and stand by and keep an eye on this. QQQI currently has an expense ratio of 0.68%. That is taken right out of your investment, so you'll never be actually billed for it, right? You'll never see it. You'll never see a bill in the mail for this. It will just come out of your investment automatically. You'll never see it. But that means that for every $1,000 that you would invest into this fund, you would pay out $6.80 once per year, which is not bad at all. Okay, on a smaller scale, you'd be paying about 68 cents for every $100 you spent. You get it. Okay, 0.68%. 0.68%. It's not bad, y'all. It's really not bad. And every ETF has an expense ratio typically. Okay, they just don't tell you that up front. Now, really quickly, let's go over what their objective is and how they plan to achieve it, because you need to know what you're investing into and how they operate in order to generate returns on your investment. Makes sense, right? If you're going to invest in something, you need to know what you're investing in and how the company operates, right? Right? I think we can agree. Starting with generating high monthly income while still participating in the equity appreciation of these stocks. That is the goal. Okay, it invests in the stocks of the NASDAQ 100 and uses a call option strategy to produce income as well. So ideally, you're getting growth exposure with an income overlay provided by their strategy. Let's bring this home. 1, the high distribution and income potential of this stock or of this fund. The fund currently advertises a distribution rate of about 14.28%. Okay. For many income-oriented investors, that level is eye-catching compared to typical equity funds. Also, it pays monthly, which is also eye-catching to a lot of investors because you're getting that monthly compounding effect. Right? 2, the growth and upside potential hopefully is captured with an options overlay added to it because it maintains its exposure to the top large cap growth stocks. Again, we're talking about companies like Nvidia. We're talking about companies like Apple. We're talking about companies like Microsoft. The top of the top, y'all, in the tech industry. So with exposure to these companies, you're not sacrificing the growth of these major tech companies for the yield of the dividend payout. It's very rare. Now, the options writing strategy is intended to generate that premium income and potentially capture the upside while managing some of that volatility that comes along with the tech industry and these companies. So for those of you who have someone that prepares your taxes every year, this is going to be this third point is going to be a focal point for you. Okay. For those of you that have someone that prepares your taxes every year that really knows what they're doing. Okay. This particular fund is one of the ETFs that have a bit of tax efficiency. What does that mean? One of the things the fund highlights on their website is that its option-based strategy may be structured in a way to take advantage of favorable tax treatment of particular contracts and tax loss harvesting opportunities for investors seeking monthly income in taxable accounts that pay attention to the finer details of investing like this. That potential tax benefit will matter to them. If you are unfamiliar with what I'm talking about, just talk to your tax rep. We don't have time to go into it, but it matters. Okay. Trust me. Check it out. I wouldn't lie to you. Okay. So now what role does QQQI play within my portfolio? Again, because I've invested in this already. Okay. For investors that like to focus, again, a large part of their core portfolio on large cap growth stocks focused on tech, QQQI can serve as either a substitute or a complement to that. Okay. As a replacement part of a standard growth ETF while adding monthly income in the process. It's unique because it's a mix of growth and income, and it gives a different risk return profile than a pure growth ETF. So this is what you're getting when you're investing in QQQI. Okay, the risks are different. Now let's talk about those risks, because as with any investment, there are important risks to consider. Okay, let's talk about them really quickly. How am I doing on time? Not bad. All right. Number one thing we need to talk about is that this ETF has a limited track record. Okay, because QQQI launched in January of 2024 last year, its long-term performance through full market cycles remains untested. What does that mean? They don't have the history there for us to look at a broad range or scope. Okay. The options strategy, complexity, and potential costs of this business, the income comes via selling calls. So these strategies may cap your upside and carry unique risks that are involved with options calls. because there are risks there. You need to be aware of that. Okay. Yes, there's an opportunity to capture growth, but there's also a risk as well. So even though the income is emphasized with that large cap growth, the fund remains exposed to the large cap growth stocks, which means they're tech heavy, in other words. So if growth stocks pull back or tech stocks pull back and faces headwinds, guess what? Guess what happens to QQQI? They're not immune. So if tech takes a huge dip in the stock market, if that sector is hit substantially, then guess what? QQQI will be hit substantially. You will feel the impact of that. I have it pulled up on the NEOS website. This is not a trick. You can go to neosfunds.com, and we're just going to take a look at the top 10, okay, distribution holdings. Okay, if you go to the NEOS website, you'll see this here. There's a couple of tabs there. This particular tab right here, the holdings, is where you will find their top 10 companies. Of course, you can download the full holdings spreadsheet that is going to give you exactly what this fund is invested in and break it down line by line item by line item. But for the sake of this video and for the sake of time, we're just going to look at the top 10 so I can show you that this is really is a tech heavy focused ETF. So number one, you've got NVIDIA with 9.74%. Apple second with 8.54%. Microsoft comes next with 8.1%. Broadcom after that. Amazon, Alphabet, which is Google. Alphabet, y'all. If y'all know Google, if you're investing in Google, you know Google has two different. Identifiers. Okay, Tesla is right after Google. After that is Facebook or Meta Platforms, and then after that is Netflix. All of these are tech-focused companies, okay? The tech leads this company, I believe, by at least 51% of what they are invested in, and QQQI revolves around tech. So again, if the tech market is hit, you will feel this with this particular stock, all right? And the last thing we're going to do is go to stockanalysis.com. You can get more holdings here, of course, that are right up front. You'll see PepsiCo down there. You see Lind. You'll see Cisco Systems, Micron, Energy, Palantir, Costco. Okay. Again, the full list is available for you to download, but I just want to show you here. Technology, 51.2%. Okay. That's the bulk of what you're investing in with QQQI. Let's go to dividends. The rate here, it says about 13.8%. It could have dropped, but it's usually anywhere between 13.8 to 14.2, 14.3%. You all. Again, this pays out monthly. The dividend growth, they don't have any history. Again, this is a brand spanking new stocks. That's another thing that some investors may frown upon because it's brand new. There's not a lot of history here. We don't know how it's going to perform going forward because we have no history. Although history does not guarantee, right, future projections. However, we don't have any data with this particular one. So you're taking a step out on your faith that this stock will be able to perform for your dividend portfolio and perform well. Right now, the cost is around $53 as of today, as of the time of this recording of this video. So again, you've got to weigh whether or not this stock is worth your money. Okay? You've got to weigh whether or not this stock is worth your risk. Maybe your money will be better allocated somewhere else. You've got to decide that. But I think for what this particular ETF fund offers, it's capturing exactly what I need, which is exposure to the tech, which is a more heavier focus exposure to the tech industry. That's what I wanted when I invested in this particular ETF. I wanted a heavier investment focused on tech. Focused on tech that will still provide me with dividends. I wanted to capture both. Again, this is a two-pronged attack, and hopefully it pays off. Going forward, we're going to see, all right? So if you've held on this far, I appreciate y'all. And listen, I got another video coming back because I got people asking me about what am I doing about Prospect Capital. I'll tell you what I'm doing with Prospect Capital in another video, all right? But I appreciate y'all for watching. If you watched this far, please hit the like, subscribe. I really need that. Thank you for your support. Remember to invest diligently, but more importantly, invest responsibly. And I'll see y'all on the next one. Thanks, y'all.